All right, we have more changes unfolding in the U.S. financial system and the U.S. housing market. Changes that have banks now drastically changing their loan requirements, limiting who qualifies for a loan, which types of loans they're willing to write now. And how do we know this? The Fed's long-awaited SLOOS report was just released early, by the way, supposed to come out on the 8th, but dropped yesterday. And wait until you see this, all right? A number of surprises, most notably for housing, for the housing market. Also, we're going to look at the $1+ trillion debt storm that's making landfall today, the new potential black swan that could make serious waves and kick off a massive downturn in the markets. This is all the rave right now, folks, in the investment world. All investment banks warning about this to their clients. We're going to show you some of that as well. But before we get started, these videos take time to make, right? Take time away from running my business, my family, my friends. It's appreciated if you like the video. Also, if you're not already a subscriber of this channel, consider subscribing. It helps the channel out, and I appreciate your support. Also, today's video is brought to you by SnapForce Real Estate Insights. If you want to track home prices in your local housing market, drill down by metro, county, even zip code and city, and see just how far away home prices are, how much longer we possibly may have to wait before seeing prices fall back to where they were pre-housing bubble, pre-2020, check out our product. The data syncs automatically each month as soon as Zillow, Realtor.com, Redfin syncs their monthly numbers to us. So if you're interested, I put the link in the description below this video. All right, so the Federal Reserve dropped a bombshell on us yesterday. The long-anticipated SLOOS report, the Senior Loan Officer Opinion Survey, the single most important survey that the Fed conducts. And if you're wondering why you haven't heard much about it or seen it covered much in the press, it's because normally it's not a hot topic. In normal times, this is one of the most boring topics, as it really doesn't change. Literally, for more than a decade, this report stayed virtually unchanged. But not today, folks. Right now, this is hands down a vital piece to the economic puzzle and is of top concern for Fed members. Now, if you're not familiar with what this is, the SLOOS is conducted every quarter, right? The Fed sends out a questionnaire of sorts, a survey to more than 80 of the country's largest lenders, asking them questions like these, for example. This is the actual survey, by the way, that we're looking at together. Question number 1, it says, over the past 3 months for Q2, how have your bank's credit standards for approving C&I loan applications or credit lines changed, right? Then we see the answers below it, the responses. Either they say they've tightened considerably, tightened somewhat, remain unchanged, or made it easier to get a business loan. When they say tighten, by the way, that means that they made it harder to get a loan, right? And for the first question, take a look. 0 banks eased lending conditions, folks. 0 banks made it easier for your business, my business, any of our businesses to obtain a loan, and more than half said they made it more difficult. 3 of the 63 banks who answered this particular question said they made it significantly more difficult. I love, by the way, to know which banks these were, because these three banks are obviously in a pickle. All right, so now that we're caught up on what the SLOOS is, let's look at the results. All right, now keep in mind, this is what the Fed was waiting for when they paused rates last month. They did that in big part, because they were waiting for this report. They got this report prior to the last FOMC meeting last week and decided after seeing these results, they needed to raise rates again. That tells you just how important this is, and that it's severely underreported, by the way. Loan availability, or rather lack thereof, reducing loan availability, has the same effect as hiking rates. More potent a tool even. In fact, it's theorized the speed at which an economy can crash from banks turning off the loan spigot is remarkable. Before we look at how tight it's gotten, take a listen, for example, to San Francisco Fed President Mary Daly explain how this works. This is a new clip, a different clip from the one that I played in a previous video. Take a listen.
How about bank credit tightening? Is that something you still see is going to slow the economy?
You know, it's a great question. And right after the initial banking stresses, my own estimate was that could be being important, worth about 1 or 2 rate hikes. And I do think that from the research literature that this takes a while to show itself. And so I think we're still looking into the fall before we would have a declarative statement to make about the extent of credit tightening and the effect on the economy.
All right, so here's the results now, right? This is directly from the Fed's website, just released yesterday. Ladies and gentlemen, we have wow, we have things tighter than I personally thought they would be. Look at that. This is for commercial industrial loans, basically corporate loans, right? Any loan you get for your business is included in this, as well as lines of credit as well. Now, the higher the line goes on this chart, it means that the banks are making it more difficult, making it harder to qualify for a loan. Take a look at the last report. This was for Q1. Look at the difference. Q1, Q2, Q1, Q2. And this next chart is even more important. If you've been watching this channel for a while, you've heard me talk about higher mortgage rates are inevitable right now, higher interest rates across the board for our loans. I said that countless times, made entire videos about this subject, how rates have to keep rising. And this is partly why. 3 words, folks: credit risk premium. What banks charge us to get a loan is rising. They've been tacking on these additional basis points for months now. This is how much the banks are charging you over their rate. This is partly how they tighten lending standards, making the terms more favorable for themselves, like we've been warning about. Now, things are tight, right, for the business world. We can see it right here, but still not as restrictive as they were during the great financial crisis. But that's not the case for real estate. Check this out. Close to as tight today as it was in '08, still slightly more restrictive after the '08 meltdown, but pretty damn close, folks. And what you want to focus on here is the blue dotted line. That shows general CRE loans, commercial real estate loans, which are at this point virtually non-existent. And if this isn't bad enough, right, this wasn't bad enough, the banks are now restricting loans for the housing market as well. As much as, a few of the people in the comments like to say that this has nothing to do with residential real estate, banks aren't approving less mortgages, etc., etc. Well, you'd be wrong to think that. Take a look. Both banks and GSEs are in fact cutting down on the ease to obtain a mortgage for normal people. This line right here is the GSEs, government-sponsored enterprises like your Fannie Mae, Freddie Mac, and the fat dark green line here is non-GSE, so regular banks. It's gotten more difficult, folks. It's across the board at this point, right? Every single debt product offered by lenders is now significantly harder to obtain today than it was last year. That includes credit cards, consumer loans. I tried explaining this in detail, how this is not only a corporate issue, but tightening of lending standards affects everyone, all of us, everyone and anyone who uses credit. And this is why. Take a look at consumer loans, folks, credit cards. Terms are changing right now. Card limits are falling. For instance, Discover. A lot of people have Discover credit cards. I have a Discover card. I have multiple, actually. They recently began adjusting max limits on existing customers. So if you have a Discover card, you may want to check your max limit and see if it's changed recently. Now, why is this happening? Why are banks making it harder to get a loan? There's a long explanation for that, but I'm going to sum it up in 2 words because that's really all that we need. Quantitative tightening, all right? QT, which means the Fed is shrinking their balance sheet, shedding $60 billion a month in treasuries and billions more in mortgage-backed securities. And for money to be created in the system, for more dollars to get pumped into the system, banks have to lend, right? But the Fed wants the opposite right now, okay? They're shrinking their balance sheet, trying to suck money out of the system, limiting bank liquidity, putting these banks in the position where they need to write less loans, which ties into our next story, this Wall Street Journal headline: Treasury's $1 trillion debt deluge threatens market calm. So what's this all about? Well, remember a few months ago, Congress raised the debt ceiling. Actually, they suspended it technically. Now, they did that because they were about to run out of money. The government's checking account, the TGA, the Treasury General Account, the bank account that they used to pay all their bills with, was about to go negative. So the Congress acted. All right, they do this every couple of years because technically Congress controls the purse strings. At least they're supposed to. So every few years they pass a debt ceiling bill. When that happens, Congress authorizes the Treasury to spend more than their current limit. Think of it like a credit card limit, all right? The Congress gives the government X amount of money it's allowed to spend. It can't go over it. If it needs to spend more money, which is what happened a few months ago, they have to get Congress's authorization. And this time Congress didn't give them a new debt ceiling. Instead, they suspended it entirely, which is, a completely different discussion. But the point is, just because Congress authorized additional spending, the government still has to get that money from somewhere, right? Remember, their bank account was close to going negative. So where does that money come from? Well, guess where? They borrow it, all right? They borrow the money by auctioning off U.S. Treasury bonds. So check this out. This is just wild, all right? Before the Treasury does this, they're supposed to, they have to, publish a report on exactly how much they intend to borrow. The report's called the Treasury Marketable Borrowing Estimates Report, a complete mouthful. And guess how much they are looking to borrow this time in the month of August? Just in the month of August, this current month, $1.007 trillion. Trillion with a T, folks. They just published this, which, by the way, is significantly more than they've ever borrowed before, excluding during the pandemic, in which they went cuckoo. Now, you can see it on this chart. So who buys these treasury bills that are being auctioned off? Well, they're mostly scooped up by our banks, who really don't have a choice in the matter. And this is where the crux of the issue is. Do the banks use the money that they have sitting in the RRP, the reverse repurchase facility, or do they use their bank reserves? If they use the latter, game over, folks. We will see asset values come crumbling down. This is really at the discretion of the banks. It's supposed to be their decision. The thing is, though, during the first round of treasury bill auctions last month, the $600 billion that the banks bought up, they used almost entirely funds from the RRP. So there's less and less available to pull from. So as long as the administration continues to spend like a drunken sailor, eventually, they're going to have no choice but to use reserves. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Press the dislike button. Either way, I appreciate you watching.